In the early 2000s, a wave of corporate scandals rattled the confidence of investors and the public at large. Chief among them was the WorldCom affair, one of the largest accounting frauds in U.S. history, which led to billions of dollars in losses, a massive bankruptcy, and the imprisonment of its top executives. WorldCom was once a dominant player in telecommunication, promising a new wave of global connectivity. Yet behind its meteoric rise lay a house of cards propped up by questionable accounting and unchecked leadership ambition. Today, we'll delve into how WorldCom rose to prominence, the chain of events that exposed its fraud, and the broader lessons still resonating decades later. WorldCom's story begins in 1983 with a small discount long-distance telephone reseller called Long Distance Discount Services, LDDS, based in Mississippi. At the time, the telecommunications industry was undergoing a major upheaval following the breakup of AT&T's monopoly. This deregulation opened doors for smaller companies to step in and offer competitive services. LDDS was one such enterprise, founded to capitalize on these new opportunities by offering affordable rates. One of the company's earliest backers was Bernard "Bernie" Ebbers, a former high school basketball coach and motel owner. Ebbers joined LDDS in its initial phase and soon became the driving force behind the company's growth strategy. By 1985, he had taken over as CEO, guiding LDDS through a series of mergers with other small telecom companies and steadily building its customer base. By the mid-1990s, LDDS had rebranded itself as WorldCom, reflecting its ambition to become a global telecommunications leader. The industry was booming, fueled by the rapid growth of the internet and the surge in demand for data and voice service. WorldCom's approach was aggressive. It constantly sought acquisitions to gain market share, technology assets, and new customer bases. A major milestone came in 1997 when WorldCom acquired MFS Communications, which itself had recently acquired UUNet, one of the largest internet backbone providers at the time. This move positioned WorldCom at the forefront of the dot-com revolution, providing the critical infrastructure for internet traffic. In quick succession, the company pursued other deals, including a high-profile, but ultimately failed, bid to acquire Sprint for around $115 billion, a staggering figure that underscored Ebbers' expansive aspiration. Bernie Ebbers became synonymous with WorldCom's aggressive style. He was a charismatic, larger-than-life personality who often made bold promises about the company's future. A self-described country boy, Ebbers portrayed himself as a hands-on leader who knew how to make deals and get results. Under his stewardship, WorldCom soared up the ranks of corporate America, and its stock price followed suit. The telecom giant frequently reported significant revenue growth and operational success, turning heads on Wall Street. However, even before the scandal broke, analysts and industry insiders started raising questions about the sustainability of WorldCom's business model. The company's appetite for acquisitions was enormous, and many observers wondered whether it could effectively integrate the dozens of companies it bought. Nonetheless, the roaring 1990s stock market, and particularly the late 1990s tech bubble, kept investor confidence high, enabling WorldCom to keep borrowing and issuing shares to fund its acquisition spree. By the turn of the millennium, signs of a broader tech slowdown were emerging. The dot-com bubble burst in 2000 to 2001, taking down many overvalued internet companies. Telecom carriers faced steep drops in demand for long-distance services and internet backbone capacity. WorldCom's core revenue lines started to plateau or fall, placing pressure on the company to maintain the ambitious growth targets that had endeared it to Wall Street. The conventional wisdom in many boardrooms is to ride out such downturns. But at WorldCom, top executives, allegedly including CFO Scott Sullivan and CEO Bernie Ebbers, chose a different path. They looked for ways to mask the company's deteriorating financial condition. The primary fraud mechanism at WorldCom involved classifying standard operating expenses, like line costs, as capital expenditures on the balance sheet. In simpler terms, routine costs that should have been recorded as immediate expenses were instead capitalized, stretched over multiple years. This accounting sleight of hand allowed WorldCom to reduce its reported expenses in the short term, thus falsely inflating its net income. Over time, these manipulations amounted to billions of dollars in fictitious profit. For instance, if WorldCom paid $100 million in line fees to other carriers, an expense that should reduce the quarter's profit, it would record much of that $100 million as a capital asset on its balance sheet. Because capital expenses are depreciated or amortized over a longer period, the immediate quarter's profit would look far better. The practice didn't generate any real cash flow or operational strength. It merely deferred recognition of real expenses, masking underlying losses. Many ask, how could such a massive fraud go unnoticed for so long? Part of the answer lies in WorldCom's internal culture. High-level executives exerted intense pressure on the accounting department to meet earnings targets that aligned with analyst expectations. According to employee accounts, CFO Scott Sullivan insisted on maintaining certain profit margin, regardless of actual results. The message was clear: find a way to make the numbers work. Mid-level managers in the finance and accounting teams often hesitated to question these directives, fearful of losing their jobs or being ostracized. Some who tried to raise concerns found themselves ignored or sidelined. The near-religious zeal behind WorldCom's growth narrative meant that internal voices of dissent could be drowned out by the corporate hierarchy. Ironically, one of the largest accounting scandals in U.S. history unraveled due to the diligence of WorldCom's own internal audit group. Cynthia Cooper, WorldCom's vice president of internal audit, began noticing irregularities in the company's financial statement. A routine check uncovered strange transfers and inconsistent explanations for large capital expenditure. Cooper's team initiated a deeper investigation, often working late at night, sometimes in secrecy, to avoid tipping off higher-up. By mid-2002, Cooper and her group had gathered enough evidence to suspect a multi-billion-dollar accounting fraud. They alerted the company's board and external auditors, eventually leading to revelations that shook the corporate world. Publicly, it became clear that WorldCom had overstated its earnings by more than $3.8 billion, a figure that later grew to over $11 billion as more details emerged. WorldCom's scandal broke hot on the heels of the Enron debacle. By the early 2000s, confidence in corporate governance and accounting transparency was already badly shaken. The revelation that yet another top-tier corporation had engaged in widespread fraud only deepened public cynicism. Politicians, investors, and regulators collectively demanded major reforms, eventually leading to the passage of the Sarbanes-Oxley Act in 2002, which tightened financial reporting and imposed stricter criminal penalties for corporate malfeasance. In July 2002, not long after the fraud was made public, WorldCom filed for Chapter 11 bankruptcy protection. At the time, it was the largest bankruptcy in U.S. history, surpassing even Enron's collapse. The company reported total assets of around $107 billion, and debt levels were astronomical. Creditors and shareholders were left reeling, with stock prices plummeting from highs in the $60 range to virtually worthless by the end. The sheer scale of the bankruptcy had ripple effects across the telecom industry. Banks, vendors, and other telecom carriers that did business with WorldCom faced losses. The broader stock market volatility soared as investors wondered if additional corporate frauds remained hidden elsewhere. As the dust settled, an army of lawyers, forensic accountants, and restructuring experts descended upon WorldCom to salvage what they could. The company's assets were reorganized and renamed MCI, an older brand WorldCom had acquired. MCI remained in operation but on a significantly reduced scale, eventually becoming a target for acquisition by Verizon in 2005. Key executives' fates. Bernie Ebbers, the charismatic CEO, was indicted on charges of fraud and conspiracy. In 2005, he was found guilty and sentenced to 25 years in prison, although he was released early in late 2019 due to health issues and died in 2020. Scott Sullivan, WorldCom's former CFO, pleaded guilty to fraud and testified against Ebbers. Sullivan received a 5-year sentence, ultimately serving around 4 years. Other senior executives faced legal scrutiny, but the most severe punishments were reserved for those viewed as masterminds of the scheme. Meanwhile, Cynthia Cooper and her internal audit colleagues were lauded for their integrity. Cooper was named one of Time magazine's Persons of the Year in 2002, alongside other corporate whistleblowers. The collapse of Enron, followed closely by WorldCom, galvanized public and political momentum for regulatory reform. The Sarbanes-Oxley Act, SOX, emerged in July 2002, just weeks after the WorldCom scandal became headline news. Under SOX, CEOs and CFOs of publicly traded companies had to personally certify the accuracy of their financial statement. The act also strengthened the independence of auditing committees and established the Public Company Accounting Oversight Board, PCAB, to oversee external auditors. For boardrooms across America, WorldCom became a byword for what happens when leaders chase growth at all costs and manipulate earnings to satisfy Wall Street. Directors and executives took renewed interest in compliance, internal controls, and whistleblower protection. In many ways, the WorldCom meltdown served as a sobering reminder that no company, no matter how large or celebrated, is immune to financial catastrophe if it tolerates reckless leadership and compromised ethics. A central theme in WorldCom's downfall was a culture that placed meeting earnings targets above transparency and ethical conduct. Employees who witnessed suspicious activities felt discouraged from speaking out, or assumed that leadership must know what it was doing. WorldCom's saga emphasizes the pivotal role of internal checks and a culture that values dissent. Employees must feel safe questioning financial decisions without fear of retaliation. WorldCom had external auditors, Arthur Andersen, initially, and later KPMG, but none were effective at catching the massive fraud. The Arthur Andersen firm was already reeling from its involvement with Enron, raising concerns about whether it had the independence or capacity to audit another sprawling conglomerate effectively. This vulnerability illustrated how even well-known auditing firms can fail to detect systemic wrongdoing if management is determined to conceal the truth. In addition to its direct economic impact, WorldCom's scandal left a trail of lost jobs. Thousands of employees were laid off or saw their retirement savings vanish as the company's stock tumbled. Investors, large and small, lost billions. In small towns like Clinton, Mississippi, where Ebers had once been a hometown hero, the sense of betrayal ran deep. The downfall of a once proud local success story left emotional scars on communities that had believed in the company's promise. While Enron's collapse was primarily about deceptive accounting tied to off-balance sheet partnerships and complex derivatives, WorldCom's manipulation was more straightforward, mislabeling routine expenses to artificially inflate profit. Both cases underscored how easily corporate data can be distorted if those at the top are willing to override safeguards. Other early 2000 scandals, like Adelphia and Tyco, added to the impression of a systemic crisis in American corporate governance, setting the stage for major reforms in finance and oversight. The pattern of beating the quarterly earnings estimate at all costs has undone many firms. WorldCom's leadership, determined to perpetuate the narrative of unstoppable growth, crossed ethical and legal lines once genuine operational setbacks threatened to undermine its story. This scenario is still relevant. In modern markets, the short-term fixation on quarterly earnings can tempt executives to manipulate figures or undertake risky maneuvers. Charismatic CEOs like Bernie Ebbers can create a halo effect, leading investors and employees to dismiss red flags. The cult of personality can become a barrier to accountability, as those who question a revered leader's strategy may be labeled as disloyal or lacking vision. Effective board governance requires ensuring that even high-profile executives are subject to checks and balances. WorldCom's downfall might have been avoided, or at least mitigated, if robust internal controls had been in place. Policies that require multiple levels of review for major accounting reclassifications or that guarantee whistleblower anonymity can prevent or uncover fraudulent schemes. An empowered internal audit function, independent from top management, is crucial. Indeed, the determined efforts of Cynthia Cooper's team highlight the difference one diligent group can make when it persists despite resistance or suspicion. Sarbanes-Oxley changed the corporate landscape profoundly, imposing heavier compliance burdens and stiff criminal penalties for accounting fraud. Over time, some critics argued that SOX would stifle business creativity. Yet, in the wake of WorldCom, there was a widespread consensus that something drastic had to be done to rebuild trust in capital markets. Whether or not one agrees with every detail of SOX, it's undeniable that the legislation stands as a direct legislative response to the kind of malfeasance WorldCom exemplified. Following its bankruptcy restructuring, WorldCom re-emerged under the MCI brand, distancing itself from the stigma of the scandal. The new entity attempted to regain customer trust, focusing on more transparent governance. Ultimately, MCI was acquired by Verizon in 2006 for around $8.5 billion, a fraction of WorldCom's once lofty market capitalization. For Verizon, it was largely a deal to gain control of MCI's network asset, including its internet backbone infrastructure, while trying to leave behind the baggage of the WorldCom name. Bernie Ebbers spent over a decade in prison, maintaining that he was unaware of the specifics of the fraud. Nonetheless, courts found his claims unconvincing, given that the CFO and other executives testified about how the pressure from the top had driven them to cook the books. He was granted compassionate release in December 2019 due to declining health and died a few months later. His legacy remains tied to one of the largest bankruptcies in American history and the moral failings that enabled it. Cynthia Cooper remained in the public eye for some time, advocating stronger corporate ethics and delivering keynote addresses about her experience. She authored a book, Extraordinary Circumstances, discussing the events at WorldCom from an insider's perspective. Cooper's story is often cited in business schools and ethics seminars as an illustration of the power of moral courage in the face of immense pressure. Due diligence. Investors must look beyond press releases and glossy annual reports. They need to scrutinize a company's footnotes, query its accounting policy, and monitor the health of its industries, especially if it claims extraordinary growth in a struggling sector. Robust oversight. Boards of directors and audit committees can't be mere rubber stamps. They must actively oversee management's decisions, question suspicious transactions, and ensure an environment where whistleblowers feel protected. Transparency and culture. A culture of ethical conduct requires that employees at all levels can voice concerns without fear. When entire teams believe raising questions will cost them their careers, malfeasance can fester. Avoiding the growth at all costs trap. Consistent, sustainable growth is far healthier than massive expansions predicated on unrealistic financial engineering. Companies that chase only top-line growth or short-term earnings can end up distorting financial data to meet those unrealistic targets. The downfall of WorldCom in 2002 stands as a stark reminder that, even in industries driven by cutting-edge technology and deregulation-fueled opportunities, corporate misconduct can bring down giants. Through an elaborate scheme of misclassifying billions in expenses, WorldCom created the illusion of steady profits in an increasingly challenging market. At the helm, Bernie Ebbers shaped a culture that prized growth above all else, leading employees to bend, and ultimately break, professional ethics to maintain lofty valuation. When the truth finally surfaced, the reverberations shook Wall Street, and WorldCom filed for the largest bankruptcy in U.S. history up to that time. Thousands of employees lost their livelihoods, investors saw their shares go to zero, and entire communities felt betrayed. The scandal, alongside Enron's, catalyzed significant regulatory reforms, culminating in Sarbanes-Oxley, a law that fundamentally altered financial reporting and corporate accountability in America. Ultimately, the WorldCom debacle offers key lessons about oversight, transparency, and the perils of leadership that elevates personal ambition over ethical conduct. While the telecom landscape continued to evolve, absorbing WorldCom's assets into MCI and then Verizon, the memory of one of the most notorious frauds in history endures. The company's fate underscores that no empire of inflated numbers can sustain itself indefinitely. When the facade finally cracks, the true cost to stakeholders and society can be devastating, but the experience can also pave the way for stricter guardrails, stronger voices of dissent, and a renewed commitment to corporate responsibility.